This is Financially Fit Radio with Cory Sickles from Safe Harbor Retirement Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Cory provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is Financially Fit Radio with Cory Sickles.
Welcome to another episode of Financially Fit Radio. I'm Cory Sickles with Safe Harbor Retirement Group and Wealth Advisors. If you'd like more information about what you hear on today's show, feel free to give us a call at 614-760-0670, or you can always visit us online at safeharboroh.com. And while you're on our website, make sure you check out our radio page. You can listen to previous shows, as well as you can also subscribe to this show on Apple Podcast, Amazon Music, Google Podcast, or Spotify. Also, feel free to check out our YouTube page. Just type in Safe Harbor Retirement Group. Today's episode will be there. You can watch other videos on different types of financial topics. And also make sure you check out our YouTube shorts. We have a daily financially fit tip every day as well. So you can probably learn something there, on an ongoing basis as well. We're here to help to address any questions you might have. If you have any questions, just always, again, feel free to give us a call at 614-760-0670 or visit us online at safeharboroh.com. And just remember, all meetings are complimentary and there's no financial obligation. Well, today we're going to talk about balancing risk and reward on your investments. And really what we want to talk about is how can you use this strategy for long-term success? We want to make sure you understand exactly what we mean by reward versus risk. But I think it'll be a good conversation. But before we dive into that, let me introduce you to my co-host this week and every week, and that's Tony Shore. Tony, how are you today?
I am doing great, Cory. I had a great week. My son's birthday, his 25th birthday, believe it or not, was this past weekend. We celebrated that and got outside, got some yard work done. I'm looking forward to the NFL draft this week. So, yeah, it's going to be a good one. How about you?
Yeah, the NFL draft is tomorrow. Bengals have a first-round pick. The Browns don't have any till the second round. So, of course, we have marvelous Marvin Harrison that'll be drafted from for Ohio State. My guess is he'll be they're projecting a top 5 pick unless something crazy happens. But the big payday for him.
Yeah, it's going to be a huge payday for him, and he's a great player. It's interesting. It'll be fun to see where he goes and where he ends up.
Yeah, it will be. It'll be for a lot of them as well.
Yeah. Vikings are trying to trade up to get the 3rd pick in the first round to get a quarterback. So we'll see.
Yeah, speaking about risk versus reward, Marvin Harrison kind of took that. He didn't participate in any of the meetings, any of the training camps at Indy. So we're going to find out whether it actually hurt him or it's going to be able to still benefit him. But that's a good kind of a risk versus reward that he actually even tried.
Yeah, well, that's a great segue into our topic, risk versus reward. And, there's always risk and there's definitely reward. I mean, I know that if I go back for a 3rd or 4th round at the all-you-can-eat pizza buffet, I know what the reward will be, but there's also risk involved, right, Cory?
There is definitely risk involved with that, right? Yep. Obviously, you and I know probably our listener, if you listen to us regularly, know that, I do like to golf, right? So,
yeah.
And
it's an understatement.
Yeah. But, I try to hit it as straight as I can, but that necessarily always doesn't happen, Tony. And, when you actually put it in the woods or in the places that you really shouldn't be, your next shot, it becomes into potentially a risk versus a reward shot. Do I actually just kind of chip it out, maybe try to get my par, worst case, get a 5? Or do I try to, go through trees and do what I need to do to put it on the green, Do I maybe get that birdie, or do I walk away with a triple bogey?
Do you take the safe route and know that it'll take a couple more shots to get there, or do you go for it all?
Exactly
There's
right.
risk versus reward,
Right.
right?
I could birdie the hole if I go this way, Tony, but I could also walk away with a triple bogey.
Yeah, there you go.
And it's kind of the same way with investments. If you really, think about it. And really what, we'll talk about first is your risk, right? So obviously everybody likes to have good returns.
Yeah, we all
But
do.
but when you actually have to have a good return on your overall portfolio or on a particular investment, a lot of times the only way you're going to get that higher return is if you actually probably invest in something a little bit riskier, right?
Right.
So by you investing in something a little bit riskier, you have the potential to do very well. That's the pro of being able to kind of take some risk, because really what you're trying to do is get a higher return. Maybe you want to invest in something that's more risky than the S&P 500, right? And if you're investing in one particular stock versus 500, obviously it's going to probably be a little bit more risky. But what you're hoping for is that big payday. And that's really what that is, and you might be able to reach that. But that is a pro. Obviously, the more risk that I put out there, I'm going to have a better chance in order to hit maybe some long term goals that maybe exceed my expectations. The other side of that is, just like I just mentioned ago, is if you're more risky, odds are you're probably not as diverse as you probably should be, because maybe you're investing in one stock or two stocks versus potentially a mutual fund that might have 500 or so stocks within it. So the less amount of, stocks or investment companies that you're invested in, that's actually naturally going to raise your risk. But again, what you're hoping for is that risk is going to reward you by making more money than maybe what the market's actually doing.
Yeah, and it's risk versus reward. And with finances, it seems that's always the case. And you might sacrifice some of one for another, right? I know that they say is it three things? There's liquidity, there's risk, and there's gains. And you can only have two of the three or four, right, at a time. You can't have everything.
That's exactly right. Yeah,
Safety,
yeah,
risk, gains,
right.
liquidity.
You're gonna give something up.
Yeah,
That's exactly right. And here's the one thing that I would probably say too. And this is again, this could be I'm talking about more of the pros right now, but this is also a great learning opportunity for you as well, right? You
right.
might maybe you invested in a company that you shouldn't have a little while, maybe 6 months ago or a year ago. Hopefully you've learned from that, and maybe you might go into a more risky investment, but hopefully you've learned maybe some from past mistakes, on how you choose to be more risky.
Yeah. Yeah, and learning from our past mistakes is huge. But if we can, Corey, we want to avoid costly financial mistakes when it comes to our investments and our planning. And I know that's where you come in, and that's what you help your clients do, because you go through this process each and every day and you know the pitfalls. And I know you've had people come to you that haven't been working with you previously, that have made costly mistakes. And and they said, I just wish I would have been working with you and known this before. So I encourage our listeners to pick up the phone and give you a call. What's that phone number they can call?
Yeah, our phone number is 614-760-0670. Or again, you can always visit us online at safeharboroh.com. But you're exactly right. Um, when you do get riskier, your reward could be higher. However, there are some cons to this, Tony, right?
Sure.
And I think the first one is it could be what a lot of people do not like to have, and that is a loss. By you being more risky, you have the potential to lose more money. And if you're really risky, And the market's down 20%, and depending on how you're invested, you could be down, 30 to 35%, depending on your risk level that you want to be able to do.
Sure.
So risky investments can lead to, substantial declines in value, and some of it could be quickly and it could be unexpected, depending on what particular stocks you're actually invested in. And the other side of that is you could have a lot of volatility as well. When you have more risk, then the way that the market is measured by, from a stability standpoint, is your volatility. The more volatile that you are, that means it's a little bit, it goes up and down at larger percentages. And that's really what we're kind of talking about right now.
Yeah.
Like a good stock right now, if anyone's been in the news listening to it, is DJT, which is, Donald Trump Media. Right now, it'll go up anywhere from 5 to 10% on a daily basis. That is volatility. And you have to be, if you're in that risk versus reward, that's what it's doing right now. So it's one of those situations that, you just kind of put it in there, and you have to expect it's going to be up or down on a daily basis, one way or the other, substantially. The other side of it is, I think, that everyone needs to also realize is when you invest in some of these riskier portfolios, you also might have to check on what's your liquidity in order to get out of them, depending on what you're actually invested into. You might have some things or some riskier investments, for example, that might have some type of lack of liquidity for a period of time. So, one that's pretty common right now, I'll just use an example, is because I have some clients in some of these type of portfolios, Tony, and those are REITs, right? Real estate type of investments. And a lot of times you only can get out a certain percentage on a quarterly basis. And a lot of times that's not 100%, depending on what type of REIT you're in. Well, I was actually having a conversation with a client, and he's in a REIT outside of what I would recommend, but that's what he's in. And he can't get out of it. But a lot of that's actually invested in shopping malls. Where are those going, Tony?
Yeah, that's not good. That's not good at all.
And when I say he's invested in real estate or real estate in shopping malls, a lot of times what happens is rent is what pays you.
Right.
And if it's not being rented out, therefore the stock can drop. Right.
Yeah,
and you have liquidity issues and things like that. So it's very important to know, if I do get into particular investments, what is my exit strategy in case I do want to get out? And it might be the other way, Tony. What happens if all of a sudden it goes up really quick, but you can't get out of it to try to sell on the high end? So you need to understand on what you're invested and what the liquidity is, especially when you're talking about riskier investments.
Right, exactly. And so you have to be really careful. I wouldn't want to even touch investments without working with somebody like yourself. I don't want to do it myself. I think a lot of people can make really costly mistakes, but yet I want some risk. I've got some time yet before I'm going to retire. So I don't want to pull everything out of the market and put everything in safety or cash, right? There's two sides to that coin, right?
That's exactly right. Yep, that's exactly right. And, now let's kind of talk about the second side of this, and maybe what's the rewards that you can actually get, right? So if you have higher returns, that means you might be able to hit your financial goals sooner.
Retire sooner.
And which means you could end up retiring sooner as well. Yeah. The other side of that is if you have higher returns over a period of time, is that nice little thing called compound interest. So you're actually building off of that on an annual basis. So with that compound interest earning, it's going to be able to accumulate more, which is going to help you meet your financial needs, your long-term financial needs, maybe even sooner. And it's all about achieving your goals, right? If you're getting the rewards that you want, you're going to be able to achieve your short-term and hopefully your long-term financial goals as well. But, again, when we start talking about this, you always have to remember that by doing this, I have higher risk. I have a lot of maybe potentially market uncertainty, and I can have a lot of short-term volatility if I have a riskier type of portfolio.
Yeah. Yeah, so it is interesting if you take on the risk, especially if you're younger. Your time horizon has a lot to do with this. But if you take on the risk, you can reap the rewards, especially looking at the market. It's gone up over time pretty consistently.
That's exactly right. And I think now let's kind of talk about, finding that right balance, right? And I
Sure.
think one of the first things you do want to look at is your time horizon, just like you just mentioned.
Yeah.
Where are you? Are you 30? Are you 40? Are you 50? Are you 63 and going to retire at 64? Right? So your time horizon of when you're going to need that have access to that cash is going to be crucial to be able to make sure that back to that risk versus reward. You don't want to be 100% stocks if you want to retire next year,
Right. Yeah,
right?
that's for
Because
sure.
the one thing you don't want to have happen is a 25% downturn in the market. Now you just lost 25% of your portfolio, and now you're thinking, well, I can't retire next year. So you want to find the right type of balance. And the way that one of the ways that we do that, the very first thing we start with is, what is your true risk level? You need to understand that. And if you go out to our website at safeharboroh.com, and if you go to that, if you go out to Safe Harbor, at the very top right hand screen, we have where you can take your risk assessment. It's going to ask you 11 questions, very simple. But at the end of the day, it gives you a score. That score tells us on how you really should be invested. So once we actually review your portfolio, we can make sure that you're going to be allocated based upon whatever risk level you're in. And that's why it's so important on an annual basis, like when you meet with us, we're going to redo the risk tolerance every year. Because at some point in time, your risk tolerance will start going down. And what I mean by down is you don't want to no longer have, if the market drops 30%, you have a 30% loss in your portfolio. So that, our job is to be able to work with you and manage based upon your expectations, what your true risk level is, to make sure you're allocated that correct way to get the returns that you want short term, but more importantly, long term.
Yeah. Yeah, and again, work with a financial professional, but it is important to have the right balance. And I don't think a lot of people achieve that balance, especially like you say, as they get closer to retirement, or you're a year away from retirement and you still have everything in high risk in the market, and you're still going for broke. That's going to be tough.
Yeah, that's exactly right. It's going to be tough, and you don't want to experience that. You want to make sure you have a diversified portfolio, right? You might want to be in some life insurance. I think what a lot of people think, Tony, when we talk about diversification, they always think about, well, I'm going to be in U.S. stocks, or I'll be in some bonds, I'll be in some international, maybe some emerging markets, I'll be in some large cap versus small cap. They think that's a lot of the diversification, right? And really, that is part of it. The other part of it is I might be want to also invest in different types of products to
Right.
be able to handle that, be able to make sure I'm diversified. Maybe I'm involved in a little bit of annuities, maybe a little bit of life insurance. So now what you're doing is you're getting a really holistic risk, a risk analysis or a risk management based upon multiple products.
Sure.
Some things you
You
might be
want
able to.
something with a where your principal is protected,
Exactly
because the
right.
principal you have in your that anything that's in a portfolio attached to the stock market, it's all at risk. And in retirement, you want to make sure the money that you need to pay the bills each month isn't 100% at risk. That's for sure.
That's exactly right.
Yeah.
However, you don't want to be so not risky or minimal risk. You want to make sure that you have some risk within it, because you do need to keep up with inflation.
You need the growth for inflation.
Yes, you
Yeah.
you definitely need the
Yeah.
growth. And I
For
think a lot of people might be a little blindsided right now because right now, safe money means I'm putting it into a CD, right? Interest rates are good right now. At some point in time, Tony, they're going to probably start going down,
Yep.
which means the interest that we were making in CDs and banks accounts today is going to go back to where they were before, around pre-COVID, I guess you could really say.
Yeah.
So you have to watch that, because at that point in time, you are not keeping up with inflation and you're going to have some issues. So by having a well balanced, diverse type of portfolio, you're going to be able to keep up with inflation. There's nothing wrong with having a portion of your money right now sitting in some CDs. I just think long term, you don't want to be able to have that with your entire portfolio, just like with anything else.
Right. That's true. And so achieving that right balance, knowing where your assets need to be allocated, am I in the right portfolios? These are questions people have. And I'm sure you hear this all the time when people first come to you. So, what's the solution? Get a plan?
Get it? Well, the easiest thing to do is go out and basically, what I would say is get a plan, or work with someone that's going to do the research and provide advice to you to make sure that you're doing what you should be doing.
Yeah.
Our job is to be a fiduciary to our clients, which means that we're only going to recommend what it is in your best interest. And that includes how to invest your money and in what portfolios to invest that money into. The other side of it is when we start talking about risk versus reward and being diverse. The other side of it is, Tony, is I don't think a lot of people realize this, but you have risk if all your money is in IRA money as well. We've talked about that many times on the show. You want to make sure you're also diverse from a standpoint of how your money is going to be taxed. If you have IRA money, it's 100% taxable when you take a withdrawal in retirement. So you want to make sure that you have brokerage, or what we call non-qualified type of accounts, or like money you have sitting in the bank. You can invest that. You only pay taxes on the growth of it. And you're going to want to make sure that you also have some type of Roth money that is tax-free. So when you do take that money out, you don't have to worry about what that tax rate is going to be, that the IRS or the Uncle Sam's going to charge you in order to have access to those funds. So if you don't do the right things there, then you have a huge risk, what I consider a risk, in your retirement plan, because you will pay taxes on those IRA withdrawals for the remainder of your life.
Hmm. Yeah, so taxes always play a part, no matter what we're talking about, even if we're just talking about investments, risk and reward with portfolios, right? Taxes come into play.
That's exactly right. They always
Yeah.
do. And
Yeah.
if you're working with an advisor, we should be able to provide suggestions to you on to be able to help you not only in the short term, but we're also looking out long term, which is going to be in your best interest. And of course, the one thing that we want to make sure of is, the way I look at it is you have a big risk. One of the big risks in retirement is my money going to be there as long as I am?
Yeah. Yeah.
So
And
our
there's
job is to mitigate that risk, to make sure that you're going to have some type of lifetime income, um, with the assets that you do have.
Yeah. I mean, there's crazy risk like a Bitcoin or a hot stock tip you heard from somebody in some unknown stock, and you put a bunch of money into it. So there's crazy risk like that, but then there's managed risk, right, in the market, and that's what you try to do for your clients. And I know that you and investment firms you work with, like Gradient Investments, they are actively managing those accounts each and every day, and looking at it and making fine tuning and adjustments. But you really need that, don't you? You don't want to get crazy with risk, but you also want some rewards.
That's exactly right. And the way I look at it, just way you just described it, not only am I working with my clients, but then we have professionals that are actually managing their money that's invested in the market, right?
Right.
And really, the only thing that we're really trying to do is be able to provide a great solution for our clients. And the best way to do that is to have professionals do it. I
Yeah.
mean, Tony, I'm not going to come to you if I need to get a tooth pulled. right?
Right. Don't come to me. I'll just dig in the drawer for a pliers. You know
Right.
that.
I'm gonna go to a dentist that's
Yeah.
what their expertise is in.
Yeah. Yeah. You don't want me to do dental work. That's for
Yeah.
sure.
I don't even know
Yeah.
if I even want you to if I have a broken hand, I don't even know if I want you to mess with that.
No, you for sure don't. I'm not that kind of doctor. I
Right.
just play one on the radio. I'm not a
Right.
real doctor. So, well, this is good. Risk and reward is important. And I know this is something that strategies can really help. It can make or break a retirement or your investments. So, work with a professional. Cory, how can our listeners out there get a hold of you?
Yeah. Listeners out there, you can give us a call at 614-760-0670 or visit us online at safeharboroh.com. Again, we're here to help and guide you, answer any questions you might have, but more importantly, put together a financial plan that's going to work for you and your family in retirement. Again, our phone number is 614-760-0670, or feel free to visit us online at safeharboroh.com.
All right. Thanks, Cory. And thank you, listeners and viewers, for joining us on the show today. That does it for today's episode of Financially Fit Radio.
I was going to say, join us next week for another episode of Financially Fit Radio.
Thank you for listening to Financially Fit Radio. Don't pay too much for taxes or retire without a sound income plan. For more information, contact Cory Sickles at Safe Harbor Retirement Group. Call 614-760-0670 or visit their website at financiallyfitoh.com.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.